So if there's one thing that stands out about mobile home parks is once you have them fully stabilized, they're known as cash machines. They are unbelievable. And the amount of cash flow they distribute is better than any other real estate I've ever owned. And I've owned apartments and single family and condos and office and all kinds of different stuff.
Welcome to Investing for Generational Wealth. I'm John Lai from Flat Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovation, over 500 single-family rental homes under development, and more than 350,000 square foot of industrial real estate, $700,000 of private loans, and we're expanding to other asset classes such as oil and gas ventures, mobile home parks, with the end goal of helping customers create diversified, balanced portfolios. Before we begin, quick disclaimer, as always, we're not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorneys before beginning investments. Again, I'm your host, John Lai, and welcome to today's episode, Why is Mobile Home Park Investing Considered Recession-Proof? With Jack Martin. And Jack is the co-founder of 5210, as he explains why mobile home park investing is resilient, especially in today's certain market. 5210 has a portfolio of 1,600 lots across 4 states and $55 million in private investor capital. We'll learn tons of information about mobile home park investing today. Jack, for those of us who don't know your journey, would you mind talking briefly about how you got to where you are today?
Sure. John, first of all, thanks for inviting me. This will be fun, especially when your audience has not been exposed to this unique niche asset called mobile home parks. So if there's one thing that stands out about mobile home parks is once you have them fully stabilized, they're known as cash machines. They are unbelievable. And the amount of cash flow they distribute is better than any other real estate I've ever owned. And I've owned apartments and single family and condos and office and all kinds of different stuff. Mobile home parks they're just tremendous cash flow. I'll highlight and I'll try to get there really quick. I was a Minnesota boy by birth, Midwestern guy, 17 kids in our family. So
okay.
I had, if I wanted some, I didn't do that.
That's right. Yeah.
But I think that what I learned really quick was if you wanted more than what your parents' budget could accommodate, you just had to go earn it. So I started working as a kid. That workout that's the Midwest is famous for was definitely running through my veins. So yeah, that's where I started. I graduated high school, went in the military. So I joined the Army, quickly discovered the politics there. So after my term was done, I got out and began entrepreneurship. So I was a general contractor, bought and sold lands, built spec homes. We did a whole bunch of development work. And then I got into the rental game. So I started working for a guy at our church. He and his buddies had a handful of rentals and I was just fixing them up. And the speed at which I was doing it, one of the partners said, hey, let's go do this on the side and see if we can flip these. Fast forward, I did about 2,000 single family homes.
Wow.
And at one point, the largest wholesaler in the state of Arizona. And then that got a little bit boring. I got bored with the widget world of single family homes and I switched to apartments. It was where I thought would be my final resting place in my career. But then I tripped over a mobile home park. So we did almost 1,000 units. We started out in the apartment game, buying duplexes and triplexes and that kind of thing. And then it just grows. Pretty soon we were doing 100, 150 unit apartment buildings. And most of that with a private equity or a JV partner kind of relationship. Many different funds, a lot of direct investment deals, but a lot of different capital structures that allowed for us to do that. And then I tripped over mobile home parks. I wasn't intentionally seeking to get in the business, but I was trying to bring an old apartment building that was boarded up back online. And the city said, you can't do that because you don't have enough parking. Right next door, there was a small mobile home park that had enough land to solve the parking problem. I bought the mobile home park, went back to the city. They still said no. Well, now I owned a mobile home park. I was in the business. I learned all kinds of great lessons. Mobile home parks are so unique. And I'll share this with your audience. The thing that stands out about mobile home parks that separates it from all other real estate, that the tenants own the homes. We own so
Right.
if you think about a mobile home park, put the stereotypes of trailer trash aside, because that's not what we do. Mobile home parks are essentially a giant parking lot. Instead of parking cars in each one of the spaces, you park a home in each one of the space. Whoever owns the home does all their own maintenance. So we don't have any of the toilets and roofs and those kind of things to solve for. That's on the tenant. But whoever owns the home has to pay the monthly lot rent for the space that their home sits on.
Yeah.
They never move. When I say never, that's in quotes. They rarely ever move. The only time a mobile home park moves is when it's being delivered to the site for the first time. Once it's set up and installed, it doesn't make any economic sense to move it again. So if a resident lives in that home and they decide to move across the country, they just sell it. The cost to move it across the country would be $20,000. It wouldn't make any sense. So it makes more sense to extract your value and move across the country and buy another one. Even if you're moving across the city, it still costs $10,000 and you got to get permits and pilot cars. And it's a lot of work.
Yeah.
So the only time that mobile homes come out of a park typically is when they're an older vintage home that has gotten to the point where you can't repair it anymore. So then you demolish that one and you bring in a new one. So I learned all of these important lessons on that little mobile home park. And then I was so excited about the stability. So if there's one thing that stands out about mobile home parks is once you have them fully stabilized, they're known as cash machines.
Hmm.
They are
That's right.
unbelievable. And the amount of cash flow they distribute is better than any other real estate I've ever owned. And I've owned apartments and single family and condos and office and all kinds of different stuff. Mobile home parks they're just tremendous cash flow. So I'll pause there. That was a lot, but that's how I got to where I am.
Thank you. Yeah, that's a great story and great origin, I guess, origin story of how you got to where you are. I'm curious with mobile home parks. Like I know multifamily apartments, I know self storage. What are some KPIs that you typically look at that are important to you when A, both evaluating mobile home parks for acquisition, and then B, maybe as from a maintenance perspective or operationally, like what do you want to take a look at?
Well, when we're acquiring a property, let's zoom out a little bit. The
Mhm.
things that matter to us the most is location.
Yep.
So and that's going to be similar with all real estate, but there's unique reasons why the market matters in a mobile home park. So the first one is if you can look at this from a common sense perspective, a brand new, decent quality single wide costs about $70,000 if you buy it directly from the manufacturer. There are cheaper versions of that, but I'm saying decent quality. To deliver it, set it up, skirt it, put, awnings or parking carports on it and air conditioning and landscape the place and basically make it into a model home on that lot. Your cost is probably $100,000 by the time you get there. That cost is going to be fixed anywhere in the nation with some nuance. It's more expensive in coastal regions, but only 10%, right? So let's just assume that your fixed cost of a mobile home is $100,000. The tenant who comes to buy that, so we sell these, we'll put that on there, we'll put it for sale, we'll sell it to a new resident. They're going to make a monthly payment if they're not paying cash for it, because sometimes they do sell for cash. But otherwise, they're going to put 10% down, so that's $10,000, and they're going to make a monthly payment on the 90 grand with higher interest financing. So than what you would get from a traditional mortgage, because it's called chattel financing. So they're making a monthly payment there, and then they're also paying the lot rent. Lot rent across the nation on average is about $500. So let's say their all-in cost is $700 a month for the home payment and $500 for the lot rent. They're paying $1,200 a month. If you could purchase a home outside the park in the same neighborhood, and even if it's, call it a 70s vintage fixer-upper, it's not in great condition. But if you can purchase one outside the park and your cost for the mortgage, lower interest rate mortgage, plus your taxes and insurance is equal to or close to that $1,200 a month, there's really no motivation there's no demand. You can't
Right,
sell
right,
homes, right?
right.
So what we discovered is if the median home value in the marketplace is not somewhere in the 300,000 or above range, you have a difficult time selling homes at scale.
Yeah.
So that's a long way to get to the answer of what do we really look at? If I'm not in a market that's $300,000 or above, there has to be some other compelling reason for me to take a look at it. And there
Yeah.
have been cases, but typically you'll never see us in a market where the median home value is below 275. We just won't do it.
And most municipalities are not leasing more land for mobile home parks. Is that correct?
Yeah,
The
yeah,
opportunity is pretty much fixed.
that's correct. Yes. So existing mobile home parks are really the only game. Now
Yeah.
there are on average about 10 new mobile home parks built in the United States. And when I say 10, I mean of size, 100 lots or more. Most of those are built in Texas. Texas is the most favorable state for new development of mobile home parks. But as a comparison, we're in Arizona, like our headquarters is here in Scottsdale. There was more than 10 parks knocked over in the Phoenix metro area last year. So this is a shrinking asset class. They're going away faster than they're being built. Gets a ton of institutional attention. So the really good quality parks in good markets that are owned by mom and pop owners, they're getting bombarded with offers from institutional buyers. If they go to market, in the public market, they're listed for sale. There's a bidding war on really good quality assets, and you'd be shocked at the cap rate these things trade at, usually in the
Right.
threes.
Wow.
A
And
lot of demand.
for our audience,
It's the net operating income, so the free
net
cash
operating
flow on the property against
street income.
yeah, essentially it says if I'm paying $1 million for this, what's percentage return am I getting on an
Yes.
annualized basis from the NOI? As a comparison, most apartments in a good location in a good market are probably trading somewhere in the mid fives to mid sixes
Right.
on the cap rate. So yeah, there's a tremendous amount of institutional demand, and it's because once they're all gone, they're all gone.
There are different classes of these mobile home parks. What
You
do
mean
you
from a
invest
quality perspective?
from quality?
Oh yeah,
That's right.
for sure. Yeah, so if you're familiar with class A, B, C, and D in apartments or most commercial real estate, I don't know why the mobile home park industry has done this, but they have a star rating instead.
Okay.
And it goes from 1 to 5 stars. A 1 star park is a place where you'd want to bring some backup when you collect rent. That's the
Yeah.
1 star park. It's dirt roads, high density, old trailer. A 5 star park is a brand new gated luxury manufactured housing subdivision.
Mm-hmm.
Beautiful, fully amenitized. It's basically a housing subdivision, but instead of stick built homes, they have manufactured homes.
Got it.
So in the middle there is where the opportunity is. So it's in a good location, it's in a good neighborhood, and the bones are of good quality. The prior owner has either neglected it or it's just gotten tired. So you can buy those 3 star parks and bring them back to life and lean towards more of a 4 star asset. And that's where the opportunity exists. And there's not that many of them left. There's about 80,000 mobile home parks in the United States. Half of those are too small, at least in our opinion, less than 100 lots. Half of those remaining 40,000 are already owned by the institutional owners. Half of the balance remaining is owned by professionals like myself. So there's a small pool of parks that are still owned by mom and pop owners, and that's really the focus of our attention. We'll buy 2 to 4 of those a year on average and invite just a handful of investors to participate in each one.
That begs the question, how do you find these opportunities? I assume you have a list of known operators that you want to focus on, and you consistently reach out to them and see if they would be interested in selling.
Yeah, there's 3 ways that you can buy mobile home parks. One is hire a broker to go find you them, or just work with brokers who list them. Even though we've toyed with that, we've never been successful with that. If we were, we'd have to ask ourselves, why did we win? Why were we the winning bid? We must have paid too much. So we tried it just to understand what that game was like. And we made many offers on assets that we wanted to buy, but we always came in third or fourth or fifth place. So we were never the winning bid. The truth is institutional capital is cheaper, or they have access to cheaper capital than we do.
Sure.
So if I could find an investor pool that was happy with a 5% return and that's with no upside, I would be the winning bid on every one of those.
Yeah.
But our investors expect a mid-teen IRR. Those numbers, you just can't make those numbers work. So we'll end up getting outbid. But the other two ways, there are bird dogs or brokers, whether they're formally a licensed broker or not. They spend a lot of their time building relationships with owners of properties that they know at some point those will trade. And so building a relationship with those guys is valuable. We've purchased maybe 20% of our acquisitions with somebody of that nature. And the rest of them are just building a relationship with the owner yourself.
Got it. Okay.
Yeah, some of the acquisitions we've completed, we have 7 years of sitting down and having coffee with the owner. And every time, hey, I'd like to buy your park, Gary. And he says, it's not for sale. Every time. And then
Yeah.
that one time he said, if you can get to this number, I'll think about it. But that sometimes that takes 5 years, 7 years before that happens. So it's a constant discipline thing, but that has been the most successful.
Are there specific triggers, such as I'm thinking if someone, for single family residence, for example, their sons or daughters graduate, they're in a great school district, they no longer need to live in that school district, they put their house for sale. Or maybe it's a mom and pop that's been in the industry for a very long
Mhm.
time. They're getting older, they don't want to deal with it, their kids don't want to deal with it, they put it up for
I
sale.
think the most common ones is something has happened as they age. So if you
Right.
think about most of these mom and pops, either their dad built the park or they built it themselves.
And
And we're talking about anywhere from 1960 to 1980. So fast forward to today, they're getting to that age where I want to retire. I don't want to be the operator anymore. And they discover their kids don't want it. Or they're afraid if they let their kids take over the operations, the kids will ruin it, because that's sometimes the case as well. Or they feel like there's a lot of different scenarios, but usually it has to somebody getting to that age where they're ready to retire.
got it.
That's probably the most common one. There's health related stuff. We've purchased them where we got to know the dad. The dad started to get to failing health. Kids knew that it was probably time to sell. So they wanted dad to, and dad wouldn't, but they wanted dad to enjoy whatever years he had left with some,
Right.
some money, go to the beach
Right.
and have some fun. So there have been a few cases of that nature as well.
Once you make the acquisition, do you, is it like multifamily apartments? Is there value add or different strategies?
Yeah, it's similar, but quite a bit dissimilar. I used to think, but when I bought my first mobile home park, I said, this is just a cousin to the apartment. And having done a lot of apartments, I was like, this will be easy. It's the same thing. Turns out I was not just wrong, I was really wrong. So, yes, there is a value add. I think similar to other commercial real estate, you're looking for areas where you can lower expenses, where maybe the prior owners' expenses were too high. You're looking for areas where you can raise income. And then in between, you're looking for areas that you can improve the property itself so that you can maximize both of those. So in that way, it's similar. But in mobile home parks, it's a little bit different. Almost every mobile home park is going to be master metered for water. That means there's one meter coming in. If there's any leaks in the property, or if there's any tenants that are abusing the use of water, you're paying for that. So one of the first things that we'll do is go put sub meters on every lot. And we'll use high-tech Bluetooth digital sub meters so that you're not actually out there reading them by hand. It's all via Bluetooth and software. It ends up writing their monthly bill,
Got it.
and they're paying for the actual use. That does two things. It eliminates the tenant who's abusing it, because now he's paying for it. He'll stop abusing when he discovers that he's got to pay for it. And then it also allows you to identify in real time when there's a leak underground that's part of the main infrastructure. So when the total units coming in through the master meter does not equal the total units used on the sub meters, then you have a leak.
Right.
And so you hire a leak detection company and they come out and they find it and fix it. So that's one of the first things that we'll do. The biggest challenge that you have in mobile home parks is filling vacant spaces. So if you compare apartments to mobile home parks, a vacant unit just needs to be renovated and leased. That's
Right.
it. So it's relative. You could go quickly. We used to turn 150 unit apartment buildings from a $600 rent because they were low quality or abused units to fully amenitized, beautiful, pretty, and all the units were remodeled, and the rent was at 1,100. And you could do that in 12 months. You might even be able to do it faster, but it's relatively quick. In the mobile home park business, it's different. So if you buy a property with a lot of vacancy, you have to bring in new homes and you set them up like we talked about before. You have to put them for sale. The buyer has to come and they have to go get, typically 9 times out of 10, they're not paying cash. They have to go get third-party chattel financing and go through that process and get approved. And then they move in. Every market's a little bit different, but this again is why it's so important to get minimum demand. We don't want to be in a market where you can only sell one home a year. That wouldn't make any
Right.
sense. We've bought parks where there's 100 vacant spaces or more. So you better be able to sell 30 homes a year if you want to fill up the infill in 3 years. A lot of our strategy has to do with the speed at which you can execute on that, but you can't do it as fast. So a really heavy lifting value add project is going to take 5 to 7 years. You come in and do all the capital improvements and make the park beautiful, because now
Right.
you'll be able to sell homes. You redo all the streets and you fix all the infrastructure if that's necessary, and you redo the pool and the clubhouse and all the amenities and gate it and all new lighting and landscaping and all that fun stuff. Now, when somebody shows up to buy a home, they're like, wow, this is beautiful. I want to live here. And then you
Right.
can start to sell homes at scale, right? That first part might take a year or two. And then you got to get delivery and you got to find the right units and set up all of your sales processes. We're probably in year 3.5 on a huge park in Arizona that we bought that has over 100 vacant lots. We've probably sold 60 homes there at this point. We still got 2 to 3 years left. So it'll end up being somewhere in year 6 when we finish that. So there is value add, but it takes longer. Now, here's the good part about it. Look at mobile home parks like the tortoise and the hare, if you compare them to apartments. Once you get to fully stabilized status, which means all the CapEx is done, all the deferred maintenance is solved for, the expenses are where they should be. You've filled every vacant lot with a home and you've sold it to a tenant, a resident owner, so they own it. All I have to do is maintain the roads and the landscaping and the pool if there is one, and a clubhouse if there is one. You can reduce your expenses down to where if a large enough property, you could get your expenses into the high 20s on a fully stabilized mobile home park.
Yeah.
That's why they end up being such great cash generating assets. So, or most apartments, they might be able to get to where they're fully occupied for a brief moment, but there's always going to be an ongoing vacancy rate, always. I think that the mindset of your resident in a mobile home park is so different. So you think about, you're going to buy a house. That's a permanent housing decision that you're making. So the mindset of a mobile home park tenant, and having been in both businesses, is pretty easy to see. The apartment resident sees their lease as temporary. I'm going to live here until I find something better or until I buy my home or whatever they're going to do. Whereas the mobile home park tenant sees their lease as permanent. I'm going to live here forever. Now, things change. People do move across the country but then they just sell it. And for us, if you think about what's the most expensive event that happens in apartments if you own them? Vacancy. It's turnover. So you've lost your income. You have to put money into repairing the unit. Then you got to put money into advertising and leasing for the unit. Sometimes, depending on the economy we're in, you have to provide incentives to somebody who's come here and you get 3 months free or a TV or whatever. All of that bundled cost is the cost of turnover. So to get your turnover cost to zero, it's impossible. It'll never happen. That's the most expensive cost that doesn't exist in the mobile home park game. So when you're done and it's fully occupied, so one of your tenants says, hey, we're going to move to New Hampshire, so we're going to sell our home. Great. You need some help with that? Yeah, I'd love it. Help them do the transaction with a new owner or a new tenant owner. Last month, the prior owner paid the lot rent. This month, the new owner pays the lot rent. There's no gap in the middle. Somebody, whoever owns it, is paying the lot rent. So it's so different because we don't own and manage the units. We own the land and we're leasing lots. Here's another thing that really stands out. During COVID, we all remember COVID, when the moratoriums for eviction were in place, there was a lot of strategic default.
Right.
So if I'm a resident in a apartment and I know that they can't kick me out for non-payment of rent, maybe if I'm a nefarious character, I'm going to not pay the rent. So we know that happened a lot. I have
Right.
buddies in Phoenix that had 100-unit apartments that were 40% in default, but they couldn't kick these residents out. That went on for probably 10 months, I think, in Arizona. And then at the end of that 10 months, when the moratorium was lifted, they got evicted, but all they lost was their deposit. So all the owner could collect or keep was the deposit. So he lost
Right.
10 months of rent and he got maybe one in return.
Yeah.
And he also got left with a unit that needs to be repaired and he has to go release. So here's the difference. And this is something few people are aware of. And this is probably the thing that will stand out the most with respect to why mobile home parks are so stable. Why do they go through recessions so well? If a tenant doesn't pay their lot rent and they get evicted from the park, the penalty is the forfeiture of their home. They might have paid 100 grand for this home. Maybe they've been making payments on it for 6 years and they owe 55 grand. They have some equity there. If they decide not to make the lot rent, they get evicted and they can't take their home with them.
Yeah.
For that reason, during COVID, we had about 700 lots back then. We collected our rent from 100% of the lot rent, all of it.
Oh, wow.
Yeah, there was zero default. Now, there were a handful of cases where there was some COVID-related challenge for half a dozen of our tenants, and we built a little program for them. That's different. But they were all able to catch up, by the end of the year. Now, they either lost their job or they actually got COVID and they were sick or something of that nature. So we did help those people along. However, there was a handful of rental homes that we had, and this will tell the difference between the two asset classes. When we purchase a park, a lot of times they'll come with a few rentals. Our goal is to sell it to the existing renter, so they own it, or to not renew the lease, fix it up, and sell it to a new resident. So our goal is to have 100% tenant-owned homes in our properties.
Right.
We always have a few because we just purchased a park. We're purchasing them every 90 to 120 days now. Those tenants all defaulted. Every one of them decided not to pay their rent because they didn't own the home.
Yeah.
In the same fashion as an apartment renter, they knew at the end, all they lose is their deposit. So they all defaulted.
Yeah.
The stability that occurred in mobile home parks has to do with a dynamic that's only present in mobile home parks, tenant ownership. So they have a vested interest. That's their neighborhood. They all act like they own it. John, you've walked through an apartment complex as a stranger. Just go walk through any apartment complex. Nobody will say a word to you. John, who are
Yeah.
you? What are you doing?
Yeah.
They know right away. Who's this guy?
Yeah.
Never seen him before. What are you doing here? And they take ownership. They feel like it's theirs. And to some degree, it is. Like they have home ownership in this piece of land and they care about it. It's their community. They know everybody. Some of our tenants have been there for 40 years. So, yeah, it's so different.
I know you spoke about water metering, electrical and sewer. Are those metered as well? When I think about triple net commercial leases, it's not really that because there's a land lease and then it sounds like there's water leases. But are there other type of utilities that are metered as
Yeah, so
well?
typically the electrical is almost always individually metered. So when a tenant comes, he's getting his electrical turned on directly from the power company, and that's
Oh, I
directly
see. I
billed to
see.
him.
Kind of.
Water and sewer are like cousins. So typically the fee charged for water is also, or the fee charged for sewer is billed by the amount of water that runs back into the sewer.
Got it.
So if you use 10,000 units of water coming in, then those 10,000 units of water probably went out. And that's where your sewer bill is calculated. So in the
Got,
same case with the resident, when we sub-meter the water, that sub-metering, the number of units they use will calculate both their water and their sewer charge.
got it. The other question I have was if there are homes that need to be replaced, or maybe there are some lots that are empty and you need to place a home in there, do you partner with mobile home companies to come in and place a home there? What I'm getting at is, do you pay for the home, or is there a third party that comes in, a mobile home provider that comes in and places a home there and then sells it out to the owner.
Yeah, there's three ways to fill vacant spaces generally. There might be
Right.
nuance to each one of these, but first one is to outsource it all, meaning go meet with the local dealers where they sell mobile homes on the street corner in that market. Create a relationship with them and say, hey, I have these vacant spaces. Incentivize them to sell homes to residents and have those homes moved to your park. That's one.
Right.
The second one is to buy the homes yourself and hire a third party, whether it's local real estate agents that specialize in the sale of mobile homes in parks or a third party that specializes in doing that for community owners. But in that case, you're buying the home yourself and you're getting it all set up and then you're handing the keys to the sales process to somebody else. And the third way is to do it all in house. Do all of your own marketing, have your own sales team, be in charge or in control and pull every lever. So we've found that there's success in all three of those, but it depends on the market. So
Yeah.
some markets are really, really difficult and you just got to roll up your sleeves and do it yourself. Nobody cares about it as much as the owner does. Some markets, and I'll use College Station, Texas as an example. In that market, you cannot build any new mobile home parks. So there's a moratorium against that. And you cannot put mobile homes on a parcel of land in that market anymore. So all of the dealers in the marketplace know that there's the only opportunity for them to sell affordable mobile homes is on existing lots that are in the market right now that have been grandfathered. So in that case, you have dealers fighting over your vacant lots. They literally will fight over them. If you have a really good quality property, you could sell a house a week there. And you don't really have to do any work at all. You just have to
Right.
create the agreements and then make sure that the quality or the standards are met so that you don't have a mess there, right? It really depends on the demand and the dynamics in the marketplace, but all three of those work. Now, here's what doesn't work. Put up a sign saying, bring your mobile home. That
Yeah.
doesn't work. Never seen it happen. It probably will never happen. There's a rare case where somebody who lives in the park already has a family member that says, I would like to live here too. And they do go do it on their own. They go to the local dealer on the corner. They look at model homes like you would if you were going to go car shopping. And they say, oh, I want this one and I want it to be on space 171 in this park. That does occur. But trying to attract drive-by traffic to come in and look at a lot and say, I want to move a home in here, they don't have the clue how to do that. So
Yeah.
the most effective method is to do it right, bring it in yourself, set it up yourself, make sure that it's perfect because now you're in control of the look and feel of the entire community. And then you may hand the keys to somebody for the sales process, or you may do it yourself, but at least you've controlled quality of the home and how it was set up.
For private equity investors that are looking to invest in mobile home parks, how do they go about doing it? What should they look for in an operator?
Yeah. So first of all, I'd like to highlight a couple of things. We've been doing this for a while. But the flavor of the LP, so the investor, we call them LPs, small check writers versus the $1 million check writer and what they're looking for. So small check writers, and let's call those 100 grand. They like mobile home parks because they're pretty confident they're not risking the principal. Mobile home parks are so stable. When Nate and I were looking to get into this business, we did the research to try to find a foreclosure in the state of Arizona, zero. Then we went to the state of Nevada, zero. This is in 2008, 9, and 10. There
Yeah.
should have been a foreclosure.
Right.
Texas, we couldn't find one in the markets we wanted to be in. That's when the light bulb came on for us. If we're going to build a business and we want to remove the risk, or at least to the degree where risk that we can't control, like another GFC kind of meltdown, let's go pursue the asset class that never forecloses. Let's do that. So look at worst case scenarios. So both check writers like that. The idea that the likelihood of loss of principal is really low. The likelihood of a coupon, cash flow distributions going in the right direction perpetually is really high. So yeah, you might start out with a low coupon, 3 to 4%, but some of our parks are kicking out 12% cash on cash right now. We've only owned them for 8 years.
Yeah.
A mid-teen IRR, they all like that.
Yeah.
And then the tax advantage, which is substantial. So the difference between the smaller check writer and the larger check writer is that the most important thing to the small check writer is how much can I make and how soon can I get my money back? The larger check writer says, how much tax savings can I get? And how can we never sell? I still want my money back. Do a refinance event and give me my money back so we take all the risk off the table, but I'd prefer to never sell. So one of the things that I'll share with your audience, and the One Big Beautiful Bill brought this back, the bonus depreciation that's afforded to mobile home parks is substantial. At a minimum, dollar for dollar coverage. So if you invest $1, you're going to get $1 of passive loss. That is an incredible benefit. You can't get that in most other asset classes. If the right flavor of debt is involved when you purchase the property, it could be as much as 150% coverage.
Oh, wow.
So now think about this. You're an investor, you have a problem with tax, and you need some passive losses on your K1 to offset some of your, whatever your problem is. You invest $1 million, you get $1 million to $1.5 million in passive loss on your K1. You don't want that recaptured. So you're looking for a sponsor who's built a program that will allow us to keep these forever. We're not going to pay the bonus depreciation recapture, and we're not going to pay capital gains. Instead, what we're going to do is we're going to refinance at intervals, return capital, and rinse and repeat. And we're going to buy really good quality assets in great markets where these are legacy hold assets. They're irreplaceable. So with that kind of backdrop, I think that's important. What should they be looking for in a sponsor? I think the most important thing to get right when you're investing in a passive fashion in any investment, get the people right. Without question, that's the most important thing. So if you can't find in your heart to trust the people, if you don't believe that these people will do the right thing when things are going bad, you should go look for something else to invest in. I don't care how good the deal is. So you have someone with a nefarious intent, they could bring a great deal. They will still figure out a way to take advantage of you. They always will. So make sure you get the people right. I think there's 2 or 3 things that follow thereafter. One is, what's their track record? Have they done this before? Particularly in mobile home parks, are they vertically integrated? Do they do all their own internal property management? Do they manage all their own maintenance and CapEx? Do they have a solution for home sales? Do they understand how to execute the strategy? It's one thing to have that designed on paper, and it's another one to have gone through the trenches and gone through a few wars. So I think that's important. I think transparency is critical. How do they protect your capital to avoid Ponzi schemes, cooking the books, misappropriation of funds, and human error? What do they do to solve for those things? None of us want a Bernie Madoff experience. None of us want to get in bed with a sponsor who, yeah, we like them and they're fun. They seem honest, but I don't know if they really are. And then the truth is we're humans. So the possibility for error does exist. So what we've done to solve for that, and I would suggest that your listeners look for these kind of things, not just with mobile home park owners, but with other sponsors as well. We've put a neutral third party in the middle. They're known as fund administrators. They do all the reconciliation of bank accounts on a monthly basis. They are the ones who draft all the waterfalls. They manage the investor capital. They'll manage the distributions. They manage return of capital, proceeds when there's a refinance or a sale. They just make sure that the documents that we sign in the beginning, all of the agreements in those documents are met and they're upheld. So, and then they also report in a transparent fashion because they have no bias. So they tell the investors, this is exactly what happened, and they don't discolor it. So they also do something really unique. If the sponsor has been forward thinking enough, and they manage succession should the GP pass away. So the last thing an investor wants is, I made this passive investment. I love these guys and they're great at what they do. And they just died in a plane crash. And now I'm in charge.
Yeah.
You don't want that. And we've been thoughtful because we know there's so much nuance and this is such a niche asset to identify potential successor replacements for us to step in to solve for that if we were to pass away. I care about my investors' experience if I would have passed away, but I also care about my beneficiaries. I would want my wife to be cared for in a fashion where there was somebody intelligent at the helm. So we're one of the top 100 owners in the United States. We have some really good friendships with other guys that we would feel comfortable stepping in to wind these things down should we pass away. So we've already set that in place. And that third party administrator would be the one who would trigger that should we pass away.
That's
So
great.
there's probably more that we could share, John, but in the interest of time, because I know we're coming up against a hard stop here,
Yep.
they should at minimum be looking for those things.
Okay, perfect. I appreciate that. We are at times. How can investors find out more about both you and your company?
So my company name is 5210. That's the number 52 and then TEN. So 10 is spelled out. They could just go to our website, go to the contact page, fill out a little form, and they're probably going to get an email directly from me in response. So
Okay.
a little bit unique. I like to know all of our LPs personally. A lot of these investors have become my friends. They have a direct line of communication with me, which is both good and bad. But yeah, they've become friends and family of mine. The way we operate is a little bit different than some do. But you reach out to me, you're going to get me.
Okay. We appreciate that. I will include your contact information in the description of this particular podcast webinar, and investors can reach out that way. Don't forget to like and subscribe on whichever podcast platform you're listening this on. And that helps us make sure that we can continue bringing you educational content like this one. Thanks, everyone. And until next time, keep learning to invest for generational wealth.